Are markets more fragile than they used to be? It seems like the wind starts blowing the wrong direction and markets can move very, very, very quickly, faster than in the past. Is that just an illusion, or is that real? I've got some perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so are markets more fragile today than they normally have been? Or is that just a figment of our imagination, right? Does it seem like, hey, it's hot, cold? Does it seem like risk on, risk on, risk on, risk off, everything sells? I've been looking at this for a long time. In fact, this is part of the reason why we've adopted a diversified buy and hold strategy along with a momentum strategy, even though it's not perfect all the time, is simply because of really three reasons. The market's more global, and so there's more factors that could come into play and push and make markets more correlated, is number one. Number two, the 24 hours news networks, where you can you can have that fear and hysteria shared at all times. And then with technology, it's very quickly to make trades and to act on things that could push markets much quicker. And so that's been some of our thinking for now 20 years here at Korhorn Financial Group, but there's even more research recently that suggests, well, markets might be more fragile than what you would actually think. They're more fragile now than what they've been in the past. All right, so take a look at this Financial Times article from Robin Wigglesworth. What a name that is, but I mean, intelligent guy here. Take a look at this article. He's talking about over the past decade. Let me just read a couple excerpts here. The past decade has been characterized by unusually calm but strong and long stock market bounces that have occasionally been punctuated by brief but exceptionally ferocious nosedives. This isn't a new idea. This is sort of just part of the investing reality, okay? However, recently there has been more this risk on, risk on, risk on, risk on, risk off, and then everything drops, okay? And let's just cite a couple recent examples here. And I'm not talking about COVID because the government shut the economy down, and right, so I'm not talking about that. But let's just talk 2021, okay? Tech stocks and large growth had been doing great all of 2020 and for the first couple months of 2021. And then right as interest rates started to rise for whatever reason, large cap growth or tech companies dropped 20% in 2 weeks. So everything that worked and was surging dropped 20% in 2 weeks. And I'm not just talking about an individual company or a small little sector or industry. I'm not talking about that because that can happen. That is part of the normal investing experience. Now I'm talking about the NASDAQ, right? Or I'm talking about these large components, large asset classes just plummeted 20% in 2 weeks. And then they rebounded just to do the exact same thing a few weeks later. In April, dropped, I think it was 18% just in a couple of weeks. This is extreme. Recently, we've had the fastest correction in the Russell 2000, tied for the fourth fastest correction ever, going from an all-time high, dropping significantly just in a matter of days. I would read through this article if you're curious, okay? Because to me, it still suggests having that dual strategy approach, because a buy and hold strategy, you're just going to get all the euphoria and then those fast and quick drops that could be prolonged as we've seen in the past. I would complement that with a momentum strategy, even though it's not perfect, okay? Few reasons why, and the author cites this as well. The primary concern that the author cites is liquidity imbalances. When you print trillions of dollars and stuff it into the system all at one time, you're absolutely going to get liquidity imbalances, and that is going to distort markets 100%. I agree. But I would cite three different reasons why markets are a little bit more fragile. Number one is so much passive investing. In the past, even before mutual funds, but definitely before index funds and exchange traded funds, people would invest and they'd be selective about what they're investing. Then we had mutual funds and you were buying more baskets of investments, but there was still some selection process. Now that we've got so much passive, and the evidence is there. I believe in passive investing, right? But the evidence is there of its benefits. However, that creates more complacency in the market. And as I showed you a few videos ago, there's been more money piled into stocks and stock funds this year than the past 2 decades combined. Passive investing is creating some complacency when all of a sudden the mood changes on Wall Street. That sudden, those reactions can create a sudden fragility in the markets. The other reason why I think there is more fragility in the market is we've got more tech prompted trading than ever before. Okay, so I brought up on a recent video the 200-day moving average. I believe in technical analysis. We don't trade exclusively off of that. It's a whole animal in and of itself, but it's very, very interesting. You can definitely see patterns in the market. Are they as predictable as what some of them make them out to be? No. Okay, but they do add some perspective and help with some short-term trading decision making. And so, but to me, there's more algorithms, there's more quant analysis and quant trading models in the market today. That moves markets, right? So if the S&P 500 sees a normal routine correction of 10%, but you've got a bunch of algorithms out there that say, well, if the market drops 10%, sell, that is going to exacerbate and increase selling pressure, causing things to drop even faster. To me, that is creating some fragility in the markets. But then the granddaddy of them all, and the article states this as well, to me, the central bank backstop, the central bank manipulation, the markets having a hard time, we're going to print a bunch of money, we're going to lower interest rates, we're going to see inflation, ignore it, see inflation, ignore it, see inflation, say it doesn't actually exist, and then finally say, okay, no, there's a problem. To me, that backstopping of markets and the economy by the central banks, I'm not saying, I mean, we'd be in a really severe situation if it wasn't there, right? But with so much intervention, I think that creates also complacency, but also fans the flame for folks to take more risk and speculate more with investments. And then all of a sudden, if we get wind of, the tide's starting to change, central banks are starting to change their posture, or this added risk is starting to create some unintended consequences, wham, everyone starts pulling out and the music stops and hopefully you find a chair. I think that's creating a lot of financial fragility in the markets as well. So to me, I don't think this is a recent phenomenon. I don't think this is just a perceived thing. I think it's real. I think markets for those reasons and others are just more fragile today than maybe they've been in the past. Depending on what the Fed does and where we go from here, it's going to be interesting to see if there is a great reckoning where we go back to more normally behaving markets. We'll see. That could be an extremely painful process. I would make sure that you've got the right investment strategy, the right blend of strategies in your financial plan, okay? Making sure that you're working with the CFP on a diversified buy and hold type strategy, using index or passive strategies, passive funds, but also a dynamic momentum type strategy that's not going to move in the same direction as your diversified portfolio would. So work with your CFP on that. If you don't have a CFP on your team, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.